Today it closed at 324. I had a 312 2 days ago on Friday. No, excuse me, Monday morning. I keep all these figures here. That's how we've got all this stuff. It was 312. It's already back to 324. But what it did was test the support zone. The support zone held, but now it's taking off again. And so I think we're headed to 350. Now, what does that mean? It means that mortgage rates are going to go up another 3/8 of a point. And they're around 5% right now. So 5 3/8 puts a whole bunch of people out of the market because they don't qualify anymore. Now, LIBOR is coming down, and some of the lenders are using LIBOR. The 1-month LIBOR today closed at 0.31 of 1%, which is absurd. They may as well give money away. And the 3-month, which is the important one, was 0.75, down from 0.83 the previous day, Monday. And I think that is what the Fed is concentrating on, and they're trying to get lenders to use in the basis of the 3-month LIBOR rate for lending. And, of course, that's a personal choice. And if they use the 3-point LIBOR, they'll probably have rates indefinitely at around 5%. So the pressure on the yields is to the upside. And why is that? Because we've got the Fed in the market buying $300 billion worth of treasuries from the Treasury Department, and they're buying $900 billion worth of collateralized debt obligations out of the market, and they're buying them from banks, which in turn is buying Treasury. So the crux of the matter is, I think that the sellers of the CDOs are buying $900 billion worth of treasuries from the Treasury Department or out of the market. And it's all monetized. It's all extremely inflationary. And I've done innumerable programs on this in the last couple of weeks. And I figure that the Fed will have to make up out of thin air, not $1.2 trillion, probably $3 to $4 trillion before the year is over. And goodness knows what it'll be after that. Well, if that doesn't scare you to death, nothing will.
Well, I mean, in a period of less than a week, we've gone through concern over deflation to concerns now of inflation. But isn't the Fed stuck between a rock and a hard place? Because obviously, if it raises rates in order to forestall inflation, as they like to put it, they exacerbate, obviously, the housing crisis. Well,
you're right.
Which, by the way,
absolutely right. But the Treasury wants higher rates because they're trying to pull money in. So they're at cross purposes. But it's not the Fed that's going to raise interest rates. They can't do that. They're stuck. They can't move them. If they moved them back up again, the whole house of cards would fall down. It's the real market that's doing it. And they're trying to manipulate the real market. That's why the stock market's not going anywhere, because they're spending most of their money over there. They're only spending a little bit of money on gold and silver suppression, keeping it where it is, hopefully from their viewpoint, while they're trying to hold the Dow where it is, because they want everybody to be able to go out and sell stock to beef up their balance sheets. Banks, all financial companies, and corporate companies as well.
We're speaking with Bob Chapman from the International Forecaster. Another one of those commercial breaks, and we'll be back. Welcome back to the National Intel Report for this Tuesday. I guess John Stadtmiller doesn't change his bump music as often as I do. Speaking with Bob Chapman from the International Forecaster, we have a new advertiser on RBN. And it is mortgage fraud examiners, talking about mortgages, And if you are considering a loan modification or facing foreclosure, contact the mortgage fraud examiners immediately. Their toll-free number is 1-800-540-3926, or you can go take a look at their website at mortgagefraudexaminers.com. Bob, we had a pretty good day in metals. Gold closing up almost $8 at $9.26. It stuck its head very briefly over the 930 area. Is 930 resistance, or is it a little higher than that?
Well, there's no real resistance there, but I think that government has drawn a line in the sand. I'd like to keep it below that. I think until the market starts to break down, and then I think they'll give up the ghost and let it go. They're going to be more interested in trying to create rallies in the market as it goes down, and the foremost job is to keep the dollar from plunging, and the dollar is in a head and shoulders breakdown flag formation for those technicians out there, and it's gruesome.
What's
that?
How are they going to stop it? I mean, it's pretty evident that the world's losing trust in the reserve currency.
Well, the dollar probably trades $700 billion to $1 trillion a day out of the $4 trillion that is played in currencies every day. And so if the Fed devoted $1 trillion, they could affect the dollar for a day or two, and that's it. I mean, that's all they can do. Now, they can have a better impact by going into the short end of the bond market, and that would include the 10s as well, from the 10s down, and I think they'd be more effective there. So I think their efforts are going to be in the interest-rate-oriented bond market. They will try to do things from time to time in the dollar, but they know now it's a lost cause. And they will have a minor attempts at suppression on gold and silver, but gold and silver are going to move higher. And, I think more and more people are realizing that gold's real money, and the only competition is the U.S. Treasury, and it's fast losing its luster. Surprisingly, Japan and China came in, you saw through the tick figure, and were buyers of treasuries. I think between the two of them, it's in my report for tomorrow, but I'll guess they bought about $43 billion worth of treasuries. I think it was 24 for China, and the rest were like 24 for Japan, which up until recently had not been a buyer in any way for years, about 3 years. They were in there along with the Chinese. But, at the same time, you get this monetization going on, so the Treasury's trying to catch it from both ends to keep the yields down. And so it's a constant fight. None of this is easy. What I'm talking about here with Robbie, there are only 2% of the stockbrokers in the world understand what we're talking about. Right, Robbie?
You're being very generous there, Bob.
Well, anyway, they don't know. I mean, they don't even know that the Federal Reserve is privately owned, and they don't care.
They don't care.
No. They're just worried about when is my next commission coming through.
Well, exactly. I mean, I've often recounted the story when I was bushy-haired, big eyes, and had ambitions of becoming a commodity broker. And First Boston sent me for a 6-week course in Chicago. First 5 weeks of the course was psychological guerrilla warfare and how to attract money, and 1 week was devoted to what I thought we were going to be, brokers. So yeah, they basically are concerned with raising money and selling whatever brokerage firm they work for's assets, and that's as far as it goes.